It's growth in charge, but this time it's earnings for corporates. Good morning, everyone. Welcome back. Today's focus is going to be on corporate profitability. Trump's tariffs very much remain a sideshow. Despite the buffeting from tariff hysteria and from worries about AI, US stock markets are within 1 to 2% of all-time highs. But it's a better story across Europe. In the UK, again, we've had new highs this week, and it goes the same for both Germany and Italy. France, their CAC 40 index has fully recovered from the drawdown experienced post-President Macron surprising markets with parliamentary elections last year. And in fact, it must be only a matter of weeks before we see new all-time highs there. So what's driving this optimism? Well, it's earnings momentum. It's the exiting of an earnings recession across Germany and the UK, for example. And markets expect robust corporate profitability this year of around about 7% in the UK and around about 5% across Europe. Much different from the earnings contraction we saw last year. And of course, the momentum is what's driving this optimism. Markets are continuing to expect that these earnings can go even higher as the year progresses. In the US, corporate profitability remains robust at double-digit growth. Analyst consensus for this quarter was around about 8% growth in profits, and even the most lofty expectations were around about 12%. In fact, recent announcements point towards plus 13% growth for the last quarter of 2024. It's a remarkable place to be for corporates. Another support for all of this optimism is the lack of volatility in economic data. Recall 2022 and the drawdowns we had in markets, which was being driven as much by the surprise factor in inflation prints as it was by the direction of overall inflation. Well, now economic data remains very much boring. Beats or misses on either side are very modest, and in fact markets aren't really moving the dial on their expectations for where interest rates may go. In the US, there may be a chance of another cut this year, but markets don't seem too concerned. In the UK, the Bank of England seems likely to try and gradually ease rates, even as inflation creeps up above 3%. But this isn't really troubling corporates, and this is the environment corporates do crave, which is a benign macro environment and politics very much a sideshow. And that's allowing stock markets where valuations are justified and look reasonable, particularly in Europe, to reach these new all-time highs. And of course, with weaker currencies in sterling and the euro versus the dollar, this does help the so-called translation effect, which is stronger dollar earnings translated back into sterling and or euros is great for balance sheets in domestic UK and in Europe. So it's a great place to be, and expectations for today's US CPI print later on are benign. Another inline print and the stock market can carry on and reach new all-time highs. So that's all for today, but please join Chris Leland tomorrow where he will update you on the US inflation data. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.